Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic impact cost. Most investors don't realize what cost of impact we pay. Let me explain. When a stock gets a very favorable news, let's say it's broken on TV, the news draws thousands of investors who want to invest immediately, right? So if you are one of those investors who wants to build a significant position based on that news, needless to say, you will pay anything between 5 and 20 or even 40% to build your position. Today, in markets, when a stock is seen favorably by even a small section of people, the impact costs are very significant. In favored stocks, this impact cost is even higher because stocks which capture the imagination of a lot of people, which are the flavor of the season, see very little sellers. Everybody knows that they are the flavor of the season. Everybody knows that they have captured the imagination of a lot of influential people, and they're always on TV talking about these stocks. Needless to say, the investors who come in later pay a tremendous impact cost just to participate in these stock ideas. Typically, most illiquid stocks have very high impact cost. When the impact cost is high, what happens is you pay a very significant part of your potential profits in your acquisition process itself. This diminishes the profit opportunity in the idea, increases the cost, and overall makes it very ordinary from a return metrics point of view. Effectively, as an investor, it is very important to buy, build and scale up our positions with the least impact cost. What I have seen in recent years is that when markets turn very frothy, impact costs can be as high as 70-80%, and yet people want to buy these stocks. You have seen what happened after the PNB housing and Carlyle deal. The impact cost went up by more than 100%, right? So somebody who saw the deal and bought it after a week probably had to pay a very high premium. It is very important that you don't chase investments with very high impact cost, because you have to do your math to see whether it makes sense to buy those stocks after such a strong price move. Effectively, you must weigh the pros and cons and the cost and benefit of paying more for a stock than at the price at which it traded when you first decided to buy it. So the ideal thing would be to buy stocks closer to the price at which you spotted it, or you're comfortable, or you made up your mind to buy it. Effectively, after making up your mind to buy a stock, if you're going to pay 30-40% more, to me, it's only going to increase the risk associated with your investment. And that is something which will also affect the returns that you can make from what you thought was a good idea. So the idea may be good, but the way in which you build your position may make the risks higher and the returns look ordinary. This is something which every investor must avoid in these times, and it is very important to keep your impact costs low, especially when markets trade at very high valuations. So that in essence is what every one of us should remember about impact cost, understand and follow in our investing. I request you to share this video with your friends who are keen investors, who will be able to appreciate the nuance of impact cost. And I also invite you to join us on this journey. Do stay the course with us. Thank you.